Welcome to the deep dive. We've got quite a week to talk about. Really pivotal stuff happening in the financial world. The Federal Reserve finally made their move, and, well, the signals they're sending are pretty clear across the market. So our mission today for this deep dive is really to unpack what the Fed's decision means. Understand that immediate market reaction, navigate these tricky late September historical trends we always talk about, and maybe most importantly, look at sectors and even specific stocks that might be showing some real promise. For Q4, for year-end, you've shared your sources. We're ready to dig in.
That's right. Yeah, the headline news, obviously, the Fed cut rates by 25 basis points, pretty much expected. But what really, I think, grabbed everyone's attention, what people were waiting for, was that forward guidance. They basically signaled they're looking to cut rates 2 more times in 2025.
Right. That commitment was the key piece, wasn't it?
Exactly. It gives the market a bit of a roadmap, some sense of certainty, which it always craves.
And initially, we saw that classic reaction, didn't we? Like an immediate pop, especially in those interest rate sensitive areas, right after the announcement.
Yeah, a real knee-jerk positive move.
But then it was almost like just as quickly that optimism kind of evaporated. We saw more selling than buying afterwards.
Yeah.
It really hints at that old market saying, buy on the rumor, sell on the news.
Totally.
Okay, so let's unpack that. Why did that happen? We saw the surge, right? Sectors that like lower rates jumped. And the market had kind of been pricing this in for days, moving up beforehand.
Yeah, there was a lot of anticipation built in. It felt like everyone was holding their breath.
And then that relief rally was just momentary.
Well, that buy on rumor, sell on news thing was just crystal clear this time. It's fascinating how expectations can get so baked in, Even good news, like a rate cut everyone wanted, sometimes just doesn't leave room for more upside if it's already priced. Smart money sees that, maybe takes some profits.
Right. It's about psychology, not just the news itself.
Yeah. Exactly. And we saw this play out, vividly with the Russell 2000. We track that often with the ETF, IWM. So right after the Fed spoke, IWM just exploded. It shot up from around 240.5 to over 244.
Okay.
It was getting close to that June target we talked about, the 248, 249 level from that bottoming pattern, that reverse head and shoulders.
So that was the buy the rumor part in action.
Precisely. But then, and this was fast, less than an hour later, significant selling hit. IWM dropped from over 244 all the way down to 237.
Wow, from 244 to 237.
In under an hour?
Yeah, it's a drop of nearly 3%. It completely failed to hold that breakout level. And even the NASDAQ and the S&P 500, they started optimistic but showed real weakness during the day too. Didn't hold their gains.
Okay, a nearly 3% drop, wiping out a breakout. That's pretty stark. That definitely gets your attention. So what does that kind of volatility, that failed breakout, tell us about the immediate feeling in the market? How should, someone trying to make sense of things right now interpret that? Well, it signals that, while the longer-term picture might be shifting thanks to the Fed, we absolutely have to respect these immediate, pretty powerful short-term reactions. And this brings us right into that critical historical context, September. And it's let's say, notorious reputation.
Ah, yes, September. The month investors seem to dread.
And for good reason, statistically speaking. What's kind of amazing is that over the last 75 years, September is the only month that, on average, has gone down more than it's gone up.
The only one. Wow.
Yeah, it really earns that reputation.
But it's not the whole month equally, is it?
Yeah.
I remember us looking at this before. There's a big difference between the start and the end.
That's a really key point. You're right. The first half, say September 1st to the 16th, actually performs surprisingly okay. Over the 75 years, the S&P 500 showed an annualized return of almost positive 8% during that stretch, which is pretty close to the average annual return for the whole market.
So the first couple of weeks can kind of lure you in.
Exactly. It gives a false sense of security sometimes. But today, September 17th, this marks the start of what we tend to call the more bearish part of September.
Okay, here we go.
Yeah. From the 17th to the 30th, looking at that same 75-year history, the annualized return for the S&P 500 is a pretty significant minus 25.63%.
Minus 25% annualized. Ouch. That's a totally different ballgame.
It really is. A very different dynamic kicks in.
Now let's zoom in even more, because there's a period next week that's historically even worse, right?
Yeah.
This is where it gets really interesting, or maybe scary.
Yeah. If you look specifically at September 20th to the 26th, so that's basically next week, that period, historically dating back to 1950, is the second worst week of the entire year.
Second worst week. Okay, what are the numbers?
The annualized return for that specific week, a
Yeah.
staggering minus 43.09%.
Minus 43%. Wow,
Yeah.
that's a powerful statistic to keep in mind heading into next week.
It really is. And just to add another layer of complexity, this week is also options expiration week.
Right, OPEX. How does that factor in?
Well, when you have a lot of options contracts, specifically call options that are in the money, meaning the stock price is above the strike price expiring, the market makers, the folks who sold those calls, sometimes have an incentive to keep prices from rising further or even push them down a bit to minimize how much they have to pay out.
Okay, so that can act like a cap on the market or even add selling pressure.
Exactly. It can suppress upward moves. And we kind of saw hints of this yesterday if you look at, say, large cap growth stocks like in IWF ETF versus large cap value like IWD. Growth was underperforming initially, then after the Fed, it actually took a hit relative to value, and then it weakened again into the close.
So that pattern fits both the sell the news idea and these options expiration dynamics.
Yeah, it lines up pretty neatly with both theories.
Okay, so given the history, the post-Fed wobble, the options stuff,
Yeah.
it definitely sounds like being cautious makes sense for the next, say, week or two. But you're suggesting this isn't necessarily a time to run for the hills, but maybe more like an opportunity to position strategically, use any dips.
That's precisely the way to think about it, I believe. Because while we navigate this expected short-term choppiness, it's really crucial to remember the bigger picture.
Yeah.
The Fed has now clearly set a more bullish, longer-term outlook. That commitment to more rate cuts in 2025, potentially into 2026, that sets a very positive stage down the road.
Right. Lower borrowing costs,
Right.
generally better for growth.
Exactly. It signals an environment that should be more conducive to economic expansion and market gains eventually.
So despite the near-term clouds, the underlying current is shifting. This is where we start looking for where the opportunities might be setting up, right? Where the smart money might flow.
Absolutely. And with that longer view in mind, we can definitely look at some specific industry groups that seem particularly well positioned, not just because of the Fed, but also because of some powerful seasonal trends.
Okay, let's hear them. What looks strong?
All right, first up, consumer finance. This group actually had a great day today, up about 1.78%. And it's getting really close to breaking out above a key level, around 800. But what's really interesting here is the seasonality. Over the last 13 years, its average outperformance compared to the S&P 500. It starts okay in September, like 0.2%, but it grows each month, hitting a strong 1.4% outperformance by December.
Okay, so it tends to finish the year strong.
Very strong. And the odds of it outperforming just keep increasing each month through Q4, hitting 75% in December. Plus, fundamentally, falling rates usually help consumer credit and loan demand.
Makes sense.
What else? Next, let's talk airlines. This group has shown some real resilience lately. It's tested its 50-day moving average successfully 3 times since back in April.
Holding support, good sign.
Yeah, and here's an amazing seasonal stat for airlines. From September all the way through February, so a 6-month stretch, airlines have beaten the S&P 500 by an average of 23% annually over the last 13 years.
23% annually, just in that 6-month window.
Averaged out, yeah. Almost every single month in that period tends to show outperformance. You know, maybe holiday travel bookings, less summer volatility. Whatever the reason, the pattern is strong.
Okay, airlines. Got it. One more.
Finally, let's look at banks. You know, I've been kind of bullish on this sector for a bit, and yesterday's rate cut just adds fuel to that fire. We saw the Dow Jones U.S. Banks Index close above 780 for the first time ever yesterday. That's significant.
And the logic is lower rates help loan growth and margins, right?
Generally, yes. It can reduce borrowing costs for their customers, stimulate lending, maybe improve loan portfolio quality. And connecting this to the bigger picture, the fourth quarter is historically the most bullish season for banks.
Really? How much?
They average over 5% outperformance against the S&P 500 in Q4. Compare that to other quarters where performance is often negative or just flat. So you have fundamentals and seasonals aligning here.
Consumer finance, airlines, banks, definitely compelling areas, especially with that longer-term Fed tailwind. But before we get carried away, are there potential potholes? Red flags that could derail these trends even with the Fed being more dovish, what should listeners maybe watch out for?
That's a really crucial question. Yeah, absolutely. Look, the outlook is positive, but you always need to watch for, say, an unexpected, sharp economic slowdown that could hit banks and consumer finance. Or, if the Fed suddenly changes its tune again. Communication shifts matter. Geopolitics are always a wild card, right?
Sure, always something.
For banks specifically, a big spike in loan defaults would be bad, though maybe less likely if rates are falling. For airlines, if fuel prices suddenly spiked and stayed high, or if travel demand unexpectedly dropped off, those would be concerns.
So monitor the broader economy, energy prices, consumer health,
Yeah.
the usual suspects.
Exactly. You got to watch the underlying data, not just rely on the seasonals and the Fed narrative alone.
That's great context. So for you listening, these are definitely areas to keep a close eye on as we move into Q4. Spotting opportunity, but staying vigilant.
And to really capitalize on these broader trends, you often need to drill down to specific stocks. We use tools like the SETR rank, stock charts technical rank, which basically shows how a stock is doing relative to its peers, helps find the leaders.
Okay, so let's get specific. This is where it gets really actionable. You've highlighted 7 stock that seem to be setting up nicely, right? With good technicals and a story behind them.
Yeah, let's run through them. First, CoreWeave. We talked about this one before. It's big in AI infrastructure, specialized cloud stuff. Technically, it gapped up recently, cleared resistance around 105, came back, tested it from above, and bounced nicely. It's been a fast mover, could potentially run back towards those old highs near 190 if AI demand stays hot.
Okay, CoreWeave. Next.
GDS Holdings. This is a big data center operator in China. Huge growth area. It just cleared $40 on the close. The AD line, accumulation distribution, is soaring, means strong buying pressure. Relative strengths at a 6-month high. Volumes coming in could challenge the 52, 53 level.
GDS Holdings. Got it. Number 3.
PDD Holdings. That's the company behind Temu, right? The e-commerce platform that's kind of exploding globally. It dapped up, closed at 135, finally broke through resistance at 132.5 after failing like 6 times. Volume was strong, markets recognizing its growth. Could test 155.
Okay, PDD. Aggressive growth there. What about something maybe a bit steadier?
Right, how about Vita Coco Company? Leader in healthy beverages, coconut water, stuff like that. More of a consumer staple feel. It just made a clean breakout through resistance, roughly 39.50 to 40.50. Its AD line's making new highs. It's one of the strongest in food products. Good volume, good relative strength. Maybe look for an entry near 40, 40.50 on a little pullback.
Vita Coco. Makes sense. 5th on the list. Braze. This is a software company, customer engagement platforms, super important for businesses now. It looks like its downtrend might be ending. It gapped up hugely on massive volume after strong earnings. The $30 level looks like good support now. Could potentially challenge its January highs way up near $48. That's like 50% upside from here, around $32.
Brace, potential turnaround play. Okay, 2 more.
Next, Encino Inc., ticker NCO. This is an oil and gas E&P company focused on the Appalachian Basin. Benefiting from better energy prices lately, it gapped up, then pulled back right to its 20-day moving average classic potential entry point. And it's at a 5-month relative high compared to other software.
Oh, wait.
Encino is energy, my mistake there.
Right.
Relative high within its energy peer group. Standout performer.
Okay, Encino, NCO, energy play. And the last one.
Last one. VIP Shop Holdings, ticker VIPS. Online discount retailer in China. Benefiting from maybe a consumer spending rebound there. Look at the chart. 80 line soaring, price soaring, volume solid, relative strength at a 5 or 6 month high. And the big thing, it's struggled to get through $18 for like 2 or 3 years. But it just made its highest close since mid-2021.
Wow, a multi-year breakout potentially.
Exactly. Suggests a real shift. Maybe wait for a pullback closer to that $18 level or the 20-day moving average for an entry.
Okay, great list. CoreWeave, GDS, PDD, Vita Coco, Braze, Encino, and VIP Shop. Lots to watch there. What an incredible deep dive today. We've really covered some kind of 2 sides of the coin, haven't we? On one hand, the need for some short-term caution, now through maybe the end of next week, given those historical patterns and options expiration stuff. But then contrasted against that, you have this much more powerful, longer-term bullish feeling building for Q4, for 2025, even into 2026, really fueled by the Fed finally committing to those rate cuts.
Absolutely. Yeah, if you connect it all, the big picture is about balance, right? It's respecting those really strong historical tendencies, right? They exist for a reason, especially in late September. You don't want to fight that tape unnecessarily, but at the same time, you want to use any pullbacks that might come from that weakness strategically. See them as opportunities to build positions in those areas, those sectors, those stocks we talked about that have the strong fundamentals and the seasonal wins at their back longer term. I remember one September, way back early in my career, I was so convinced the market had to go up because of some news. I totally ignored the seasonal warnings. Let's just say the market taught me a quick lesson about respecting history.
Haha, a painful lesson learned is often remembered, right? That definitely cements the importance of strategy.
Yep.
So wrapping up, what does this all mean for you, our listener? It really comes down to this question. Considering both these historical headwinds that are very real for late September and those strong seasonal tailwinds that seem to be building for the fourth quarter, how might you balance that immediate need for caution with a longer-term sense of conviction in your own approach to the market right now? That's the core thing to ponder as you navigate the next few weeks. Some food for thought. Until next time, keep digging into those insights.